Do you like books? I mean, really, really like books? Then you're in the right place. Each week, your host, Sam Hankin, interviews the best of today's top-selling authors and the up-and-coming superstars of modern literature. This is The Avid Reader. Here is your host, Sam Hankin.
Hi, everyone. Welcome to another edition of The Avid Reader, brought to you by Wellington Square Bookshop. Our guest today is Scott Nations, author of The Anxious Investor, Mastering the Mental Game of Investing. It's published by HarperCollins, and it will be released on April 5th. You know, Scott also wrote A History of the United States in 5 Crashes: 1907 Panic, Black Tuesday, Black Monday, the Great Recession, and the Flash Crash, 2010. I love the names we give them. I think maybe we should start naming them like hurricanes. The two books really dovetail nicely with one another. So I definitely suggest reading both. Scott's also the president of Nations Indexes, a leading developer of volatility and option strategy indices. And you can see him frequently as an analyst on CNBC. My favorites are the ones when he gets into kind of a sparring match with another panel member. They're really fun to watch. So The Anxious Investor. You're one, I'm one. Why? We're overconfident. We sell our winners and keep our losers. It all sounds like me. We're irrational. We just want to get back to where we started. There's another one. Yeah. We hate to lose more than we like to win. And I can attest to that after 30 years of trial work. You know, is it adrenaline? Is it dopamine? Are we addicts? The behavioral biases we are all subject to are difficult to change or sometimes even ascertain. And Scott can give you a leg up on that by letting you quiz your own biases at the end of the book, which is really good. The bottom line, and there always is one, is investing is not for the faint-hearted, nor is it necessarily for the lion-hearted. Scott does a great job of humanizing the market. And if you're still depressed with your investing skills, Sir Isaac Newton likely was a much worse investor than you are. So welcome, Scott. Thanks so much for joining us today.
Thanks so much for having me.
So, well, I guess, should we start in the South Seas with Isaac? It seems logical. That's how you set it up.
Well, I mean, let's start with to answer your question really briefly. I mean, why do we fall for the biases that I talk about in the book, the behavioral biases? And I talk about several, and it's because we're human. We're all human. And I think these biases are fascinating because we're human. And unfortunately, all of the behavioral biases that I talk about, of all of the behavioral biases, none of them will improve your investing results. You would think that just out of sheer chance, some of them would actually help us. None of them do. And, you know, I'm not talking about, you know, somebody who runs a hedge fund. My goal is to talk with people who are trying to invest in the stock market to save for retirement or to fund a kid's college education, because investing is a noble enterprise. You know, we're trying to forego a little instant gratification to save for something later, make our life better later. And so I was just fascinated by the biases, and I thought the best way to really illustrate them was through some sort of narrative discussion of some of the crashes, bubbles, and behavioral biases that have gone before. And the first one I talk about is the South Sea bubble, one of the very, very first bubbles, investing bubbles that we know of. And it's actually it was a very mundane company. South Sea Company was a very mundane company. It stood between the British Crown and people who had lent money to the British Crown. And they were essentially a clearinghouse, and they paid investors an annual dividend of £6 for each share. So it's a very mundane company. And then people got caught up in the idea that, and this is where the fanciful name comes from, South Sea Company, that this franchise to do business with companies essentially, or countries essentially in South America, was going to be incredibly lucrative. And it just never worked out that way, and it was never likely to work out that way given all the restrictions. But people lost their minds, and shares of the South Sea Company went from about £125 each in February of 1720 to £950 just 5 months later. And so many of the biases that I talk about in the book are illustrated just in abundance in that bubble.
Well, so a perfect example is probably the same thing I might do is what Isaac Newton does. He buys, he sells at a great time, makes a lot of money, and then he's like, I got to get back in.
Yeah.
What is that? What is that rush that you talk about?
Well, there are a couple of things that go on there. Probably the reason that Isaac got back into the market is what we call herding, the herding bias, and that is when it's tough, when we have to exert more mental energy to understand what is going on than is normal. So things are a little bit confusing, as they might be in a bubble or a bear market or a stock market crash. Then the human tendency is to kind of shut down, look around, see what other people are doing, and then just join the herd. We think that the wisdom of the crowd, we've been told that the wisdom of the crowd is sometimes greater than our own wisdom. Well, in investing, that's not the case, but it leads to herding, and it works in both directions. In 1720, the herd was buying South Sea shares for no good reason, and they bid them up from, again, 125 to 950 in a matter of just a few months. But it also works, Sam, it works in the other direction. During crashes and bear markets, people look around, they're confused, they don't know what to think. They look around and they see other people who they think are better informed selling all their shares. And so they sell them for whatever can be got for them. And we saw that, for example, in January and February of 2009 at the very bottom of the Great Recession. So that's what's going on. That's why herding happens. Does it help your investing returns? I mean, there's a whole bunch of academic research that proves that it doesn't.
It's funny. It's a knee-jerk response when you read about South Sea, and I may be wrong, that people are going to think, oh, GameStop, AMC, the kind of meme thing. And these guys, instead of being in the bourses, they're out in cafes, like a Reddit community. Isn't that weird?
Yeah, very much so. And the social aspect of investing was clear in 1720, because as you pointed out, at one point, stockbrokers had essentially been kicked out of the exchange for rowdiness. The exchange was left to mostly trade in commodities. The stock guys were essentially kicked out. And so they set up shop in the coffee houses around the exchange, and they would trade there. And so it became very social. Just like it does now, whether it's Instagram or Twitter, and people are talking about AMC Entertainment or GameStop or some of these other names. The social aspect of investing is part of herding, and it's another aspect of it that does not help returns.
It's funny. One of the things I honestly never thought of till I read the book was your discussion of volume. How really only a few things each year should create volume. Yeah. Rather than this incredible volume. GameStop, again, for a perfect example. And it's just a company that is closing its stores, really has no market. And you talk about that, especially with the .com, pets.com. So yeah, it's really interesting explain that about volume, because it really is something I never really thought of, but it's very true.
Well, I mean, if we stop and think about the stock market, the way stocks trade, the value of a share of stock should really change the value. I'm not talking about the price, but the value should change very infrequently. There's no reason for the value of a share of stock, absent some news, to change from the morning to the afternoon. There's no fundamental reason for that. Yet, the stock market will trade billions of shares today, absent any news. And why is that? Well, there are several reasons for it. None of them are relatively few of them are fundamentally sound. Part of it is simply sensation seeking. People kind of want to just trade. They want to do something. But if you think about it again, let's just pick a stock to talk about, just because you mentioned General Motors earlier. The value of a share of stock in General Motors should not change from day to day absent news. And that news might be they announce earnings, or they announce that they're going to make a new initiative, or they're going to close something. But absent that, why would a share of General Motors lose $1 or gain $1 in value from the morning to the afternoon?
No reason at all. But look, your company deals, you do volatility indexes.
that's
I mean, go ahead.
Well, you're right. And I spent 25 years as a professional options trader on the floor. So Sam, I was one of those crazy guys in a bright red polyester jacket. It was jumping up and down like crazy. And it was tremendous fun. I'll also say that, I think we served a purpose. That is, there are institutional investors who want to hedge risk, and they did it in the option market. But that's also a wonderful laboratory for seeing some of these biases, or the way that people think about trading. In the book, I talk about the fact that one of the problems for investors is that if you do it right, you don't get much experience. That is, you don't place many trades in the course of a year. You shouldn't churn your account very often. So you actually don't get much experience. You don't get much practice. And in the book, I talk about a couple of the things that are necessary in order to learn are immediately available outcomes and a lot of trials. And an example I talk about in the book are meteorologists. Now, we may not think that they're very accurate, but they're actually pretty good, and they're in line with the level of confidence that they have. And why? Well, because they make a prediction every day, and the next day they get to see if they're right or wrong. Most investors don't get that opportunity, which is one reason that they tend to fall prey to some of these biases.
If we go into the biases, one of the ones, again, the thing about this for readers is that they're all going to recognize every single one of these biases, because I did, and I know they will. So for example, one of them is, selling winning stocks and holding on to the losers. I could give you several stocks that I'm doing that with right now, and I'm going to change it because of your book. Talk about that, because it's totally psychological.
Yeah, it's physiological, actually. And you're absolutely right. One of the reasons I wrote the book is I want people to see the biases as I want them to see the biases in themselves. And the way to do that is explain them in a narrative where they can kind of understand the dynamic. But the bias that you're describing is called disposition. It's called the disposition effect. And it's the very human tendency for investors to sell winners and hold losers. And why do we tend to do that? Well, I say it's physiological, because when you sell a winner, that is, when you actually realize a profit on an investment, there's this surge of chemicals in your brain. There's a surge of dopamine and a whole bunch of others, or actually even a little adrenaline. There's a whole surge of chemicals in your brain that you only get if you actually realize a winner. Just having a stock go up in value that you own, that doesn't do it. So that's the kind of physiological base for it. But there's also another mental aspect to it, and that is often investors will kind of fool themselves into thinking they're being disciplined. And we all realize that investing is largely about discipline. We think, oh, I'm going to sell this winner and not be greedy. I'm going to avoid being greedy. I'm going to be disciplined and not be greedy. And so I'm going to sell this winner. Well, it's easy to think that. On the other side of that, we hold on to losers. We refuse to sell losers because we don't want to realize regret. And we trick ourselves into saying, oh, I'm being disciplined. I'm going to refuse to be impatient. I'm going to hang on. I'm going to remain invested. I'm not going to be impatient. I'm going to be disciplined. Well, there's a whole bunch of research, academic research, much of it from Professor Terence O'Dean at Cal Berkeley, who proves that in the process of doing this, the stocks that you buy to replace the winners that you sell underperform. So you would have been better off if you had hung on to the winners that you had, rather than fool yourself into being disciplined, if you will. As an example, it's impossible to own Amazon at $3,000 a share if you sold it at $1,000 a share. So I'm not saying, you double up, but I am saying that don't fool yourself into thinking that you're being disciplined just because you're selling your winners.
Yeah, I know. It's the other thing, and you tell me what this one is, because I don't know if it's addressed or, yeah, it is addressed. It's like, for example, in 1995, I thought Amazon, I bought a book from Amazon in 1995. And at the time I thought, this is a great idea. And if I had put all my life savings in Amazon at that time, I would be richer than Bill Gates. And that's, you talk about feeling horrible. I knew it. The first time I saw a Tesla driving down the road, I said, this is a great idea. And then I forgot. Or oil, someone told me 6 months ago, I'm going long in oil. And I thought, okay. And then the next day I forgot. But the thing is that what people, you have your money in Vanguard index funds for 25 years because you have a long horizon, you want to take care of your kids. But you go, wait a minute, if I put it in GameStop or Amazon back then, I'm quadrupling, but I would have gone 1,000% or just the S&P. So what's that?
Well, there are a couple of interesting things going on there. Let's talk first about some of these special names. And there's some fascinating research from some psychologists from the UK. And they looked at the stocks and the way that people invested during the internet bubble in 1999. And they observed that some people invested in particular companies, not necessarily because they thought the fundamentals were really great, that the companies were going to end up being really profitable. Sometimes these people got mentally transported someplace special because of how great the product was, or the iconoclastic entrepreneur behind the company.
Yeah.
And so the researchers called these fantastic objects. And that is, investors bought these and they thought that something about the company, something about the product was going to rub off on them simply because they owned the stock, and they got mentally transported to someplace special. And so they started with fascination, and then they went beyond that as investors, and they just got really captivated by the companies. Some of the companies did well during the bust in 2000 and the subsequent years. People went from this fascination to really disgust, and they hated the fact that they'd fallen for this. That's kind of what is going on there. And we see that a little bit today. There are iconoclastic founders today that people get wrapped up in, and they end up betting more on the entrepreneur than maybe the fundamentals of the company.
Your semantics are very good, because I love the way you spell fantastic with the PH, because it seems like alchemy almost. And yeah, and the other thing is, when you talk about disgust, you don't want to think about yourself that way, but yeah, you're disgusted with yourself. So there's some really good words that it's like you're pressing your finger against a store. And the other thing you mentioned just briefly is like this cult of personality thing. Take, for example, Steve Jobs, Elon Musk, but also Cathie Wood. I mean, we're down 60 or 90% in some of the funds. And if it doubles, people will go, oh, wow, it doubled. Well, it has to double and double and double and double and double to get back to where they were. But right. They believe in her.
Yeah, and she's the one behind the ARK Innovation ETF. And I understand why people want to focus on companies that they can grow a lot. But you mentioned Steve Jobs, you mentioned Elon Musk. There are legions of investors who have invested in Apple, or have invested in Tesla because they're fascinated with those entrepreneurs, and they've made out really well. Unfortunately, again, in 1999, there were a bunch of investors who bought other companies because they thought they were equally fascinating and the founders were equally fascinating. And those didn't work out very well. And that's another trick we play on ourselves. I talk about hindsight bias in the book. We think now, because it's so obvious to us now, we think we understood it back then, even though we really didn't. We forget the fact that, oh yeah, I may have bought Apple back then, but I also bought Webvan, and I bought pets.com, and I bought all these other things.
Your analysis of pets.com is correct. And I did think this. I went, what the hell do they think they're doing? No, there's no possible way it can work. And but that's not the way everybody else thought. I mean, it seems like a great idea. And as you said, first you had to have .com, and then you decided I don't want to have it anymore as my suffix.
Yeah, that was another thing that went on back then. There were so many companies that in 1998, 1999, even if they had nothing to do with the internet, they thought, well, we can get a pop in our stock price if we add .com to our name. Lots of companies did. They got a nice pop. There's a bunch of research I reference in the book about that. Really fascinating paper has been written about it. And so, I mean, CEOs thought, why not? And then a couple of years later, it's going the other way, and people are rushing to remove the .com from the company name. Because they're being tarred and feathered simply because they're assumed to have something to do with the internet.
It's so funny when you're talking about volume. When AMC and the others went up, Tootsie Roll went up. I'm thinking, there's no reason for Tootsie Roll to go up. Absolutely none. Yeah, it is kind of insanity because, that company that was also called Zoom, but something else, and it just went sky high. And
Right.
what's the company, the one you mentioned, the printing company that had the word web in it? What was the name of it?
World.
I forgot.
Now,
Sorry.
of all the companies I thought we were going to talk about, it actually doesn't play a very big role in the book. It was an old-fashioned printing company. What was it? Worldwide. Now I feel bad because I enjoyed telling the story very much.
You don't need the name.
It was old-fashioned printing company. It existed for 80 years in Dallas, and web was part of its name, but it wasn't because of the internet or the World Wide Web. It was a web offset printing company. Again, technology that's existed for 80 years, and it was in the middle of going broke. But people thought, investors thought, because it had web in the name, it must have something to do with the internet. And so they bought up the shares of a company that was literally in bankruptcy.
Yeah, it goes to the, and then it goes to, which I didn't know the term, FOMO. So talk a little bit about that.
Yeah, this is another part of the social aspect of investing and one of the biases. And people, the fear of missing out, and it's part of hurting. People look around, they're a little confused, and they see investors doing something, and they think, oh, well, that investor must know more than I do, must not have the questions that I have, and so I'm simply going to mimic what they do. Well, as we've discussed, that's a horrible investment thesis. And one of the reasons it's a horrible investment thesis is because after you've herded into a stock or sold your stock because everybody else says to sell it, then you're really limited in your alternatives. You're limited in alternatives to only what other people show you that they're doing. And so that's why herding, fear of missing out, piling into these few names can be doubly expensive for investors, because what do you do after you've gone in other than what you see other people doing? So it's all part of the herding bias, which again it's a terrible investment thesis. And actually Keynes talked about it, probably the most famous economist of all time, talked about it quite a bit. And he said, listen, there's absolutely no proof that what he called the social aspect of investing, what he really meant was herding, is profitable. There's absolutely no research to it. And he was kind of bloodless about it, but what he really meant was it's pretty stupid.
That pretty much that boils it down, really,
Yeah.
doesn't it? I mean, and the other thing is, what's the investor's prayer? I just want to get back. I just want to get back. But there's no real reason why you're going to get back. But talk about that bias, because it is so, I still think it's psychological.
Well, this is, I call this the trader's prayer. And every trader and now it's all electronic, but in the 80s and 90s, it was all floor-based. Trading was principally floor-based. Every proprietary trader, everybody trading for their own account or their firm's account, has said this to themselves. you have a position on, it's not working out very well, and you pray, the prayer is, God, just get me back to even. Get me back to even and I'll get out. And that's the trader's prayer. And unfortunately, we see a lot of investors are doing that sort of thing, particularly now when the stock market's had a little bit of trouble. God, just get me back to even and I'll get out.
And the great metaphor you use is talk about that one day of horse racing from the first race to the end.
Yeah, and this is another bias, and it's fascinating, and actually another example of people probably being pretty well aligned with their capabilities are professional handicappers at racetracks. And it's because, again, it's a defined exercise and they get lots of examples. But when it comes to the daily gambler, the person who goes out and is not a professional handicapper, the bias is for them to bet too much on long shots and not enough on the favorite. That is, we tend to overbet on long shots and underbet on the favorite. Why is that? It's because, and this is what goes on with investing is, or at least with trading, is much of it is sensation seeking. We're trying to get a sensation. We're trying to enjoy what we're doing. And let's face it, it's a whole lot more fun to put a $2 bet to win on a 50-to-1 long shot than to put $2 to place on the favorite. Over time, betting on the favorite's going to generate more money for you, but it's not a whole lot of fun to do that. And so people at the racetrack don't do that. And we see the same sort of thing in investing and trading. People like to put money on what are called lottery type stocks, that is, things that are really swinging for the fences. And again, it's a horrible, and there's a fair amount of academic research about this. And it's a horrible investment thesis, but much of it is about sensation seeking. And it happens even among professional investors. So again, there's more research out there that says that hedge fund managers, so professional investors who buy high performance sports cars, are worse investors than hedge fund managers who drive minivans. They take more risk. They underperform. Their funds are more likely to close down than the guy who drives a minivan.
And the interesting thing is, and this happens with gamblers all the time, and it happens in the market, is that last race where you go, it's the end of the day and you're down and you just go, I'm just going to put it in. And again, you want to get back to even, right?
Right. Yeah. And so we fall prey to long shot bias during the course of the day. That is, we bet on too many undeserving long shots. And then you're absolutely right. The last two races of the day, all we want to do is get back to even. It's God, just get me back to even. It's the trader's prayer. And so this long shot bias is exacerbated tremendously during the last two races of the day. So we lose our minds when we have an opportunity, we think, to get back to even, and we'll put everything that we have left in our pocket on the long shot in the last race of the day.
The funny thing is, your book kind of irritated me because it made me realize how stupid I was. I'm just plain stupid, like you said. The obverse, I think, would be, and maybe it's not the obverse, would be the mortgage debacle on countryside, because it isn't the same thing.
No, well, and the goal of the book isn't to irritate anybody.
I was only kidding. I'm trying to sell your book.
Okay. Well, it's to help everybody understand, help them see what they're doing, and why they're likely doing it. I would say people fall for these things because they're human. In my book about stock market crashes, I write about the mortgage debacle that came to a head in 2008. And there were there was a lot of magical thinking there, and so people, even professional investors, then fell for some of these biases, and it certainly did not work out well. We just weren't really paying much attention, and we just didn't think that it could go wrong back then.
Oh, speaking of selling your book, do you have a copy of it there that you can hold up?
I do.
Yeah, and being a bookseller, people can say don't judge a book by its cover, but everyone who comes in does.
Yeah.
And what I like about the cover is the word anxious, because it gives you that feeling, doesn't it? It's like,
Well, I enjoy listening to your podcast, and I know that you do like to talk about the book cover.
I know, I do it every time.
I like that because as an author, you work on the stuff inside, and then you get to help a little bit about the cover, and it's how you're going to face the world. It's how your book's going to face the world. So I'm glad you do that, because we do put a fair amount of research or thinking into what the book is going to look like.
Yeah, and I know it's like a comedian doing the same act every night, and I would feel bad doing that, but I can't not bring it up because it is so true. I mean, people walking into that bookstore, look at the front table, the covers they like, unless they know what book they're going to buy, the covers they like are the books they're going to buy. The blue is perfect. People love blue. And the idea when it says anxious, and you can see the anxiousness because of the like serrated, jittery type. So it really is a good cover.
I'm glad to hear you say that. I wish I could take credit for it. Everybody at HarperCollins has been fantastic when it comes to that. I'm proud to say I wrote every word of the book. I didn't have very much to do with the cover design.
Yeah, it's funny because publishers want to do the covers because publishers know what sells by the cover. They don't want the author to do it. It's smart. The other, you talk about these guys who were too big to fail, whether it's Lehman Brothers or even in a way Deutsche Bank, simply because they wanted to have a presence in New York. They decide they'll loan to somebody who no one else will loan to. Where does that come from? Because this is a gigantic bank whose stock went from 122 down to nothing.
Right. Probably the behavioral bias that investors fall for the most, and it probably costs them the most, is overconfidence. Investors are overconfident in nearly everything that has to do with investing. Their ability to pick winning stocks, their ability to time the market, even their ability to explain to you their investing results over time. We're overconfident about all of that. The Nobel Prize winner, Daniel Kahneman, who famously wrote Thinking Fast and Slow, has said that, and did a whole bunch of work in this space. He famously said that overconfidence is the one behavioral bias. If he had a magic wand, it's the one behavioral bias that he would eliminate from the earth. He also said, though, that it's so entwined with who we are that you would end up changing 1,000 other things about who we are. But everybody falls for it. We all fall for it. Even professionals fall for it. And that's what happened largely in the mortgage-backed security crisis. People were overconfident about every aspect of it. They were overconfident about their knowledge of what they were actually buying or trading, the likelihood of some sort of collapse in housing prices, just about everything, their ability to get out of the market if they had to. And probably the most famous example is AIG, American International Group, which insured the value of a bunch of mortgage-backed securities, famously saying, there's no way we'll ever lose even $1 on this insurance that we're writing. And I mean, that's just the epitome of overconfidence, particularly when you realize that they ended up losing 85 billion with a B dollars.
It's funny how the word subprime had a meaning and then the meaning changed.
Yeah, and then everybody thought that they knew what they were buying, and then when some of them started doing some research to find out what was actually in these mortgage-backed securities, they found out it was very different than what they thought. They thought that they were buying mortgages of somebody who was just a little bit away from being a prime borrower, and they found out no, what they were buying was just trash.
It's interesting that, and if you go back, which I also read, A History of the United States in 5 Crashes, if you go back to the flash crash, initially it seems like, again, it's completely different than what you're talking about, but it actually wasn't. But explain how that happened. No one understands that. No layman understands what happened.
But and people, the one question I get most frequently about the crash book is, why talk about the flash crash?
Right.
Which happened on May 6, 2010, because it's by far the least known of all those crashes. The market came back a fair amount later in the day, but at one point, the Dow Jones Industrial Average was down 10% during the course of the day. And it happened essentially in the blink of an eye. And it happened because it looked like the Eurozone, the European Union, was going to come unglued. It looked like Greece was going to have to leave. There was absolutely no contingency in the way that worked for a divorce, if you will. And it looked like they were going to have to leave. And the day before the flash crash, mobs in Athens had rioted, and they'd set a bunch of buildings on fire. They killed some people, and it really looked like that was going to come unglued. And so the next day, an American money manager decided they wanted out of the market. They wanted out of the market now. And so they decided to sell $4 billion worth of stocks. And they wanted to do it essentially in an instant. And that's what really crashed the market. The reason I write about the flash crash is even though it's the least known of the 5 I write about, is because the next crash is going to look like the flash crash. It's not going to look like the panic of 1907. It's not going to look like what happened in October of 1929. It's not even going to look like what happened in 2008. It's going to look like the flash crash, a purely electronic, algorithmic, unthinking, absent human interaction sort of cascading crash. And so that's why I write about that. And that's really, I think, the risk. We saw a little bit of that in March of 2020 as the pandemic started to unravel. There was no human interaction, or not as much human interaction in the stock market as we would have liked. And that's why we saw that market tumble, what was it, 35% in the span of about a month.
Yeah, it's funny because you did mention world events slightly with regard to the flash crash. And now, the situation, it's a perfect time to talk to you because the situation now is, my son sent me from Twitter, some guy said, he attributed it to Warren Buffett, which I'm sure he didn't say, but he said, if you believe that there's going to be a nuclear Armageddon, you should invest, but it might not be, you should invest all your money, because if there isn't one, you're going to make a fortune. And if there is one, you'll be vaporized.
Right.
I'm thinking analysts are actually looking at this kind of like that, which is also stupid.
Well, it's a little, yeah, it's scary. To your point, if and who was it? Keynes that said, was it Keynes that said, in the long run, we're all dead?
Yeah.
And so, you do have to think about, I guess you have to think about that eventuality as an investor. But Sam, that, the timeline for writing a book is measured in years, not days or weeks. And so you write a book, and you agree to write a book, and you start writing it. And all you can do in a situation like this is hope that when it comes out, it's timely. And
yeah, right.
for good or ill, the anxious investor is coming out at it when it's timely.
Yeah, it's funny. If you've listened to my podcast, you know that I talk too much. There was even a comment, isn't the interviewer supposed to not talk? But two things. My uncle, as he was at the end of his life, I said, he was a big investor. I said, so how did you do overall? He goes, I broke even. And I thought, okay. And then the other one, when I was playing golf with my dad on Monday, 1987, and it happened, and we're in the middle of the golf game, and I was going berserk, and he goes, just pull in your horns. And that was really good advice.
Yeah, and that, partly that comes from having perspective, and it comes from having a little bit of experience. I bet your grandfather did better than break even. I mean, the stock market, if you invest sensibly, is a great way to build build wealth, and a great way to save for retirement and to fund kids' educations. It would have been very easy for people to lose their minds on October 19th, 1987. It would have been easy to think that the economic system was going to come unspooled. And a lot of people thought that. Largely we have Alan Greenspan to thank for stepping up immediately and saying, the Federal Reserve is here. We have money to lend. Don't worry. The problem is not going to be liquidity. One other thing I talk about in the book is really fascinating to me, is called hindsight bias. And it's our tendency now to think we understand what's going to happen because we fool ourselves into looking backward and saying, okay, it all is so clear to me now. And then we fool ourselves into saying, you know what, I knew what was going to happen then because it's so clear to me now. And obviously there's a huge disconnect there. And so that feeds into overconfidence. We become overconfident about our ability to divine what's going to happen in the future because we trick ourselves about our understanding of what happened in the past.
And that goes to it's a word, the graduality of what happens in the minds and physiologically to an investor. And you equate it to a certain extent with Elizabeth Kubler-Ross and the stages of grief. Talk about that a little bit.
Yeah, it's her stages of grief are a little bit, and I in the context of these fantastic objects, I make the analogy there in that with some of these really fascinating companies that make fascinating things and are run by these iconoclastic entrepreneurs, you learn about it. That might be the first step, and then you become fascinated by it, by the company or the product or the person. And then the next step is you just give yourself over completely. You kind of the fantastic stage, and you think that owning those shares is going to make me a better person, not wealthier, but going to make me a better person, a more interesting person. That's kind of the third stage, like the third stage of grief. But then for the fantastic objects, then we realize, oh my God, things are not exactly as great as I thought. And so we start to experience a little regret. And then finally, the last stage is disgust. We're disgusted with the stock that we bought. We're disgusted with the company. We're disgusted with the founder. We're disgusted with ourselves for falling for it. Maybe we're disgusted with our broker for not talking sense into us, or we're disgusted with our spouse for not talking sense into us. And that's the I guess the arc that a lot of people experience in these sorts of things. And that's why I made the analogy to Elizabeth Kubler-Ross, the arc of understanding of grief.
Every time you appear on Squawk Box, or anybody appears on Squawk Box, they're essentially asking you to look into your crystal ball. And we're talking about how timely this is. And, the book will be published April 5th, and it's going to be very, very timely. So I guess I'm asking you to tell me about your next book that's going to look back on this. And you look through your crystal ball. What's going to happen now? You don't know, do you?
Well, no, and nobody knows. And anybody who tells you that they know with any degree of specificity is likely to be a charlatan. There's the famous quote, what is this? I know exactly what the stock market's going to do. It's going to fluctuate. Well, if anybody says anything beyond that, then they're a charlatan. That said, the stock market will go up over time. It goes up over time because companies generate profits and people work hard, and we develop capital, we deploy capital. The stock market will go up over time. Is it a straight line? No. And you shouldn't expect it to be a straight line. So the stock market will go up over time. And if you have a long enough time horizon, it's a great place to build wealth. If you have a short time horizon, then you probably shouldn't have that money in the stock market. You just shouldn't. So what's going to happen in the future? Stock market's going to fluctuate for a while. People will continue to be nonsensical about some of the biases, and Some people will do really well, make a lot of money, end up with a nice retirement, fund their kids' educations because they understood the biases when they fall for them, and they avoided them as much as possible.
My youngest daughter, 4 jobs she had this summer, and all she did was put it in the S&P 500. That's it.
Well, that's if she can hold on to it long enough, she will be stunned by how much it can grow. But part of it is you have to discipline yourself to not fall for the biases. And good for her. I mean, that sort of person is the one that's going to end up ruling the world. They're disciplined, they do the right thing.
That's what everyone says. They all say she's an old soul. She's going to rule the world. She's at the University of Richmond at the Robbins School of Business now, and taking 6 classes and joining every club and fraternity in business. So yeah, I don't know how these kids became overachievers being children of mine, but they have. But I was going to go towards a conclusion, but if you've listened again, I'll just go off on a segue before I end. Tell me if you remember. I don't want to put you on the spot because you may not remember, but when the bubble companies joined the South Sea, because they thought, oh, well, we can just, and the Bubble Act and all that. What was the one company that was so incredibly, no one would ever invest in it? There was one, wasn't there?
Well, there were a number of, and I talk about them in the book. There were a number of these. The mania for South Sea spilt over, and most of them were scammers. Realized, oh, we can start some company, and we can borrow from the mania that people are feeling for South Sea. So there were these fly-by-night companies. They were called bubble companies or bubbles, to do nearly everything imaginable. One of the companies raised a bunch of money from investors, promised to make money by trading hair, human hair. There were some that were going to turn lead into gold. There were others that there was one famously created by a guy named Puckett. He was going to build a defense gun, which was an early version of the machine gun, but it would be able to shoot round bullets at Christian enemies and square bullets, which were thought to be more devastating, more impactful, more dangerous, at Turkish enemies. So he raised a bunch of money to do that. Probably the most famous one, guy put up handbills in the coffee shops around the exchange in London, and said that he was starting a new company, but that it was so special that nobody could know what it was going to do. And he set up a table in a room the next day, and shares were £100, but you could buy them now for a $2 deposit. You'd pay the balance in a month. And he raised he collected £2,000 in cash, which back then was a ton of money. And he said it is so secret that nobody is to know what it is going to do. Well, he took his £2,000 in cash and left the country that night.
That's the thing. You laugh, but then you realize we're not really that far away from that, and maybe we'll get closer. But I kind of left you off the hook. So what's going to happen? Simply. Next 2 weeks, next month, next 6 months.
Oh, no. If I've learned anything from writing this book, it's that I'm not going to do that. It's impossible to not be anxious right now. Again, stock market's gyrating. There's a war raging. Inflation is spiking. The Federal Reserve is raising interest rates to snuff out that inflation. So it's impossible to not be anxious right now. But really the last third of the book describes what is normal, because what's going on right now is not normal. And if you're trying to invest for 20 years, then basing an investment thesis on what's going on right now is a horrible way to invest. So the point is, I describe what's normal, what does the market normally do, what's average, and that's the way to think about your investment thesis. So what's going to happen in the next 2 weeks or 4 weeks? The market's going to fluctuate. It's going to be easy to be anxious. Some people will give into the biases. They'll buy because they see other people buying, or they'll sell because they see other people selling, or they'll fall in love with a new company or product or entrepreneur, and they'll blindly buy the shares that he or she is selling. We'll focus on the things that we can remember rather than the things that are normal. That's what's going to happen over the next month.
Hey, I thought of a good way to end. Promise this is the last question. You know, there's self-help books in my bookstore. There's books by Malcolm Gladwell, like The Tipping Point. So yours seems to fall in the middle. You're not really saying, okay, this is a way to make money. It's basically, this is a way not to lose money. Right?
Yeah, I very much appreciate the comparison or that construct, because again, investing is a noble exercise. We're delaying gratification now in order to have a better tomorrow, better retirement, better educations for our kids, that sort of thing. But there is no magic recipe to investing. It works. It's a great way to build wealth, but there's the best way to do it is, and I talk about this in the book, is to not fall prey to the biases and instead focus on investing in low cost, say, index products. Continue to invest. Don't try to outthink the market. Don't try to outwit it. Don't be overconfident. Don't herd. Don't overreact. Don't give into the social dynamic. Don't fall prey to the disposition bias, thinking that you're being disciplined, because you're not. You're actually being greedy because you want the spike of chemicals in the brain. That's the last third of the book is really how to be an intelligent investor.
Yeah, and it sounds like I'm creating a bubble, but if you read the book, it will change your life. That sounds like bubble mentality. And the reason why it'll change your life is because, as I said at the beginning, not without exception, each of the dispositions, each of these biases is so resonant with the reader. That's the reason why I think if you can listen to it, if you can understand it and say, okay, you know what, I'm going to think about this. I'm going to think about this with intent, with purpose, and good process. If you do that, I think the book is really helpful. Okay, Scott. Well, thanks so much for talking with us. And it's Scott's the author of, I said the first one, History of the United States in 5 Crashes, which is great. But The Anxious Investor, Mastering the Mental Game of Investing is going to be out April 5th. And you've listened to my podcast, but it's true. It'll be on the front table and in the window. So thanks so much for talking to me today.
Thanks so much, Sam.
Talk to you later. Bye.